Not-for-profit organizations, the accounting updates you need to know, was a live webinar that was originally produced on Thursday, June 16th, 2016. The presenters for this presentation were Gary Dubas, Janice Snyder, and Jim Schellenberger, all with McConley and Asbury. Enjoy this webinar recap and visit us online at www.macpas.com for more information about our future events and presentations.
Thank you, Tyler. This is Janice Snyder, and as Tyler mentioned, I'm a partner here at McConley and Asbury, and I'm here with Gary Dubas, who's our nonprofit segment lead, as well as Jim Schellenberger, as he mentioned, a senior manager. I'm going to start off with some technical accounting updates specifically focused on the FASB's project to revise the not-for-profit financial statements. And then Gary's going to walk us through some updates to the Form 990, and then Jim's going to take us through the uniform guidance, as it's now being referred, or the uniform administrative requirements, and the things that you will need to know and how they impact your organization. So this webinar is certainly designed to fit into 50 minutes, so these topics are going to be touched on very high level as we go through them, but hopefully it gives you the information you need to know to do a little more research or follow up on them for the things that are specific to your organization. So thank you for joining us this afternoon, and I'll get started. So as I mentioned, the first section is not-for-profit reporting, and this is what I'm going to talk about today. And this is presentation of financial statements of not-for-profit entities. And this affects all nonprofit entities as well as healthcare entities. And there are some differences for the healthcare entities that are with us today. So this exposure draft was issued in April of 2015. It quickly got a lot of attention when they started talking about direct method cash flows and revamping classifications of net assets and liquidity disclosures, and some of that's still true, but some of that has been changed a little bit as they've gone through their FASB meetings and as they got their comments back, which were due last August. So hopefully if you wanted to participate in that process, you were able to submit your comments when they were due. So the first phase of this project, Phase 1, as they call it, which is what I'm going to talk about most today, starts with net asset classification. So currently we have 3 classifications of net assets, which is unrestricted, temporarily restricted, and permanently restricted. This exposure draft is proposing that we will now move to 2 classifications of net assets. The first one being net assets with donor restrictions. So this will capture everything that we called temporarily restricted and permanently restricted in the past, and net assets without donor restrictions, which will mostly be your unrestricted net assets. Disclosure of the amounts and purpose of the board-designated pieces of those net assets without donor restrictions. You're going to have to disclose more information there, what it's for. A lot of organizations right now will say it's restricted for capital, it's restricted for endowment, or restricted for operations. They're going to be looking for a lot more detail within this standard about how the board is restricting that and for what purposes, a little bit beyond those 3 items that we are used to seeing. In terms of the placed in service requirement for capital restrictions, you had choices before that you could have a restriction for capital and go and buy, say, a building with that donation, and it would be temporarily restricted, and you would relieve that over time out of your net assets. Now they're saying that as soon as you expend the money on the capital expenditure, that will become a net asset without donor restriction and not have to sit in that restricted category. The other thing they're focusing on in Phase 1 is underwater endowments, classified as net assets with donor restrictions. So they are going to keep any of those underwater items still in the restricted category, whereas when they went underwater in the past, the presumption was that the unrestricted assets would have to cover that shortfall, and that underwater piece would end up in unrestricted net assets. So moving on to the next portion of this, they're really looking hard at expenses. And their exposure draft and what they are concluding with this is that expenses will have to be disclosed by nature and function. And you still have a choice whether it's in the notes or on the face of the statement of activities. But you have to report the nature and the function all in one location. So you can't have one of them on the face of the statement of activities and one of them in a footnote. You have to put that disclosure all in one place so that they can be compared. And they're creating some examples of what that would look like so that you can leverage that. So you have to show that relationship between the functional and natural classification. The one thing they ran across with not-for-profit healthcare entities and how they would disclose this function and nature and what that potential footnote would look like. And they've actually moved some of that into a future project and may be addressed as part of phase 2. The next item there that this phase is addressing is the operating measure. So there will be improved disclosures over operating measures. If you don't know what I'm talking about, then lucky for you, you're not required to have that in your industry. But healthcare entities are required to have what is called a performance indicator, which is designed to be similar to a net income equivalent for for-profit entities, so you can more easily compare not-for-profit healthcare entities with for-profit healthcare entities. So they're going to want a lot more information, but only if you choose to disclose that performance indicator. And as I said, healthcare entities have to, other nonprofits do not. So moving on to, aside from the direct method cash flow that was very concerning, the liquidity disclosures are still part of the exposure draft. And in all the meetings, they're trying to come up with examples and guidance to put out there when they issue the final standard for examples of liquidity. But they will definitely want information useful in assessing liquidity. So they want qualitative information indicating how the nonprofit, how your organization manages its liquid resources and its to meet the cash needs for your expenditures in the future. And they want you to be looking out at least 1 year is what the standard is saying. You're not required to go beyond that, but certainly they say there are times when you may need or want to go beyond that. If you have debt or lines of credits coming due within, say, 13 months, you wouldn't be able to stop your disclosures and information at just the 12-month mark. And they will also want quantitative information indicating the availability of financial assets to meet those expenditures over the next year. So I'm certainly curious to see what a lot of those liquidity disclosures are going to look like, because that's something very different. And as I mentioned, in terms of the accounting standards, some are concerned that with these liquidity disclosures being new, the nonprofits are kind of setting the benchmark and leading the charge on that, which is what some organizations didn't really want to see happening. But it looks like they are here to stay. We'll find out when we get the final standard. The official date is Q3 2016, although individuals from the FASB have said it's pretty much done and just waiting final approval. And it is possible that we could hear something from them as early as the end of June, which is only 2 weeks away. So as I mentioned, the statement of cash flows. Oh, sorry. We're going to go back to the previous slide just for a moment. On the statement of cash flows, you have two options for presentation, as you always did, the direct method or the indirect method. They have decided that they will not require the direct method of presenting the cash flows, but if you do choose to use the direct method, you will no longer be required to reconcile that to the indirect method. So potentially a little bit of good news there. All right, on the next two slides, I just wanted to show you what was in the exposure draft and what I do believe they're continuing with when they come out with the final standard. And this shows you the statement of activities, which has one of the more significant changes, where typically these columns would show up as unrestricted, temporarily restricted, permanently restricted, and then a total. And you would see all those columns and activities listed out in that manner. So this gives you a clear example of what it would look like without donor restriction and with donor restriction. And it also shows you a little bit as you move down through the non-operating changes. They talk a lot about the investment return and what has to be included in that and netted in that number, which I'll be talking about on the future slide, but you can see right there down below your operating excess number there. And I also wanted to show you for the healthcare entities that are with us today, if you flip to the next screen, this is the same statement of operations, as you would call it, for a nonprofit healthcare organization, but you would see it's the same information as on the statement of activities for a regular not-for-profit, but you see it flow straight through of activities without donor restrictions and coming down to your operating excess of the 18,776 or 18 million on that page, which for most healthcare entities, that would be your performance indicator, and then continuing with the without donor restrictions and moving down to with donor restriction activity. So it flows in a similar manner to what healthcare entities would currently do. You just have those different headers and some different classifications there. And then you also see the investment return net at the bottom, which we will talk about on the next slide. So in terms of the investment return, you're now required to present your investment return net of external and direct internal expenses. And in the comment letters, this got a lot of feedback, and there was a lot of concern over this because what if I'm a large nonprofit and I have one employee that manages all of our investments and that's their job? So 100% of their salary would go into those direct internal expenses under the initial exposure draft, and now we would be basically telling a lot of individuals in the organization what this person makes. So they did tweak that a bit through their meetings and said that internal salaries and expenses would still be netted against these investment returns. Well, that would not be required to show that and to net it against that. And the investment return in the endowment net asset roll forward is also not required. So a little bit of relief there from the disclosures, and certainly something that makes a lot of sense, particularly given the concerns and the comments that came in. And the last one is cost allocations. So how are we allocating those costs? How are we getting to those different buckets of program services, management in general, and fundraising activities? So they're really taking a closer look at refining the definition of the management and general activities and putting more guidelines around and disclosures around how you're actually allocating each of these costs among the program and the support functions. So certainly when you think about areas where you'll have a little bit of work to do, that cost allocation is definitely one of them as a result of this standard. Some of the other stuff, while very important in changes to formatting of financial statements, it may not be as difficult as really laying out these cost allocations and finding the way to simply and easily disclose that information because a lot of these allocations are anything but simple and easy. So that really concludes everything that's coming in through phase one. And then as they're looking at phase two, they're certainly not as far along with phase two. So they're going to say in terms of the operating measure, phase two is really going to focus a lot more on this and potentially is going to really focus on that performance indicator for healthcare entities as well. So it's the items really not addressed in phase one. And then they're looking at, is there going to be requirements for any intermediate operating measures and other requirements during the period, and how to define these operating measures, because for nonprofits in terms of disclosures and GAAP financial statements, we really haven't had to disclose these operating measures in the past. They also want to look at certain categorizations of the statement of cash flows and how to realign some of those items and where they should go. In the original standard, in the original exposure draft, they were saying that fixed assets and purchasing of them in a nonprofit could potentially be operating cash flow activities, whereas now they said, wait, we're going to put that on hold and move it to phase two and take a harder look at that. That's all I have to say about phase two at this point. So in terms of this standard, what we do know is that retrospective application will be required. So the 2 years or 3 years, whatever you need to present, will be required when you do this, and you'll have to look at each of those years and how they're going to change in terms of financial statement presentation and certainly the footnote disclosures. They've also stated that this will be effective for fiscal years beginning after December 15th, 2017. So if you're a calendar year, this is the calendar year 2018 when you're going to have to implement this standard. And for a lot of the fiscal year nonprofits, this would be the year ended June 30th, 2019. So that seems kind of far away to me, but I know it's going to be here before we know it, and certainly something you want to be thinking about. So when this standard does come out, they have stated that you will be permitted to early adopt the standard. And as I said just a moment ago, officially they're saying Q3, but some individuals at the FASB and some of the conferences we've been to said it may even be out by the end of this month if the advisory committee can approve it. So that kind of summarized the not-for-profit reporting section of the FASB update and where that is, and certainly we're going to have some news on that pretty soon. And the FASB's been very busy in a lot of other areas as well. So I have the next two slides, that's a tremendous amount of information, but I just wanted to put them out for you so you were aware of these standards if you're not already. So the first one is the presentation of debt issuance costs that will be effective for 12/31/16 year ends and then 6/30/17 year ends. You can adopt it now. And this really focuses on deferred financing costs if you have any of those on your balance sheet. And as long as there's debt associated with that and it's not a line of credit with no borrowings, those other assets and deferred financing costs are going to move off the asset side of your balance sheet and move into net of your debt in the liability section. So just something to be aware of. Certainly talk to your accounting firm or your auditors about that. Revenue from contract with customers. Goodness, we've been talking about revenue for nearly 10 years now, but we actually have a date. It is going to be effective, and for most of you, we're looking at 6/30/2020, or calendar year ends 2019. You can early adopt this starting in 2017, and you are going to have to retrospectively adopt and again show that comparative information for all the periods presented. The only thing I wanted to point out there is the number of accounting standards updates related to revenue from contracts with customers. So if you think the standards are done, clearly not the case, and there are more exposure drafts and things continuing to evolve as they need tweaking for industries and certain circumstances, and I'll show you a few of them on the next slide. But just keep in mind that the revenue standard is still being updated, still being tweaked, and still being edited by the FASB through additional standards. So certainly something to watch closely. And the last one is leases. So if you don't know by now, leases has been talked about again for a decade, since 2006. This is a finalized standard. It was issued the beginning of this year, and it will be effective for most of the nonprofits in 2021, if your fiscal year, and in 2020. So as I think about all of these items and all of the changes, you're looking at 2019 for the new financial statements. You're looking at 2020, these is if you're a 6/30 year end, you're looking at 2020 for the revenue standard and 2021 for the leasing standard. So there's certainly no lack of challenges coming up, and these are going to hit you back to back to back. So there may be some strategy as the standards get refined and as, certainly the reporting gets finalized of deciding when and how you're going to adopt and implement these. Maybe you want to take on all three in the same year. Maybe you want to phase them out because that will be easier for your organization. But certainly something you should be considering over the next 12 months. So they are very high level, just three of the standards that I know affect everyone on this call, on this webinar. And on the next page, I just wanted to show you a few of the things and the exposure drafts and projects that the FASB is working on that could affect you. And one is the disclosure framework, that they're changing the requirements for fair value. They're also trying to reduce certain disclosures and streamline pensions. So when I say status and issued, these are the exposure drafts have been issued on those dates, and they're going through their comment process now. And then in terms of, they're looking at the statement of cash flow for certain cash receipts and cash payments and how we classify them, and restricted cash as well in terms of the cash flow. But then when you get down to the middle of that page, clarifying when a not-for-profit entity that is a general partner should consolidate a for-profit limited partnership. We definitely have a lot of clients that are impacted by this one, and how they are going to apply that. There was a presumption under previous standards that the general partner would be in control, and you would have to overcome that presumption. Well, they issued some new standards that kind of kicked out that paragraph of the guidance and never really addressed it for not-for-profit. So the FASB's working really hard to get this one finished so that they can give not-for-profits the proper guidance on this. And this is a pretty urgent project for them because this standard kicks in within the next year. They're looking at consolidation and common control as well. Revenue recognition of grants and contracts by not-for-profit entities. So hopefully you're fortunate enough to have certain grants and grant money that you're getting, so you will be affected by that standard, but that is in the initial deliberations phase. And the last item is looking at identifiable and tangible assets in a business combination for public and not-for-profit entities. So the Private Company Council said we can amortize goodwill. We have different rules for amortization, things of that nature. They're now evaluating whether or not nonprofits and public companies can amortize goodwill and go back to the way things were like 20 years ago. So that concludes the FASB update. I'm actually going to turn it over to Gary Dubas at this point so he can give us some of the Form 990 updates.
All right. Thanks, Janice. Between our more technical topics here regarding nonprofit financial reporting and also the uniform guidance, I'm going to talk a little bit about the Form 990. The first thing to say is that there were no substantive changes to the 2015 Form 990. So that actually concludes my presentation.
You don't get off that easily, Gary.
All right, I do have a couple things to say. But anyways, that's good news for the preparers and also for our nonprofit clients, that essentially there is no significant new information that you've got to compile for the 2015 Form 990. But one of the things that the IRS has done overall over the years with the 990 has put out pretty good guidance in terms of the instructions for preparation of the 990 and then clarifying things from a year-to-year basis. So one of the areas that I wanted to talk to a little bit about in terms of clarification is the instructions to Schedule L, which is transactions with interested persons. And interested persons are, in our accounting terminology, are related parties. And clarifying when a business transaction between related parties needs to be reported. And this is a significant area for nonprofits. It's unusual in terms of a reporting requirements to have to report activities that are basically internal dealings, but the IRS does require disclosures regarding related party transactions. So instructions Schedule L defines who is an interested person. And that the first thing is it's your officers, your directors, your trustees, or key employees, and all of those that have been in those positions within the last 5 years. So if you're dealing with, in a business transaction with a former director who's now off the board, you have to be cognizant that you've got 5 years of potential reporting when you have a business transaction with again, a former director or even a key employee as well. Also, a substantial contributor could also be an interested person, kind of interestingly. And if you're required to report the substantial contributor on Schedule B of the 990 schedules, which is generally somebody that contributes over $5,000 to your organization, and you're required to report them on Schedule B, they would also be considered an interested person. So substantial contributors are also considered a related party regarding these disclosures on the Schedule L. And of course, a family member of the above also would also be considered an interested person. Also, you're dealing with outside companies that have a 35% controlled entity of one or more of the interested persons would also be involved. So you've got a director who has a company that they own 35% or more, and you are having a business transaction with them. You would then be required to look at the possibility of disclosing them on Schedule L, those transactions. Management companies also is a typical thing that many organizations, nonprofits, have a management company, and if that management company is owned again by a former director or a current director or officer, you may have to disclose those transactions with them. One of the key things on Schedule L is thresholds. The IRS does put out thresholds in terms of materiality regarding whether you have to disclose transactions with interested persons. And the first threshold is that all payments during the tax year exceeded $100,000. So if you have several different types of business transactions with a particular director, for example, you aggregate those all together and see if they're over $100,000. And if they are, then you're into disclosing that on the Schedule L. Also, if you have individual single transactions exceeding the greater of $10,000 or 1% of your revenues for the year, also you may have a lower threshold when it comes to a single transaction. These are key important things to keep in mind. The final thing in terms of thresholds are any type of compensation payments that exceed $10,000, the IRS wants you to disclose. Again, and that is if, for instance, you have a director and that you are paying them compensation over $10,000, it will need to be disclosed. So these are important thresholds because a lot of times you will have some relatively immaterial transactions with a director that's a business transaction, and you won't have to disclose those on Schedule L unless you hit these key thresholds. I wanted to talk a little bit about some other common errors on Form 990. Each year, the IRS will put out some examples of things, as well as other bodies that out there, the ACPA, et cetera, of common errors that happen on the Form 990. First thing, uncompensated board members are considered volunteers. So one of the disclosures in the 990 is how many volunteers did you have during the reporting year. And so if you have uncompensated board members, they should be included in that number for volunteers. So that's one that often nonprofits will forget when they're counting up and accounting for their volunteers to disclose on the 990. Reporting total voting members of the governing body are also required on the 990. So you do not report ex officio members who do not vote, and you also have officers sometimes in your organization, such as a assistant treasurer, a secretary, et cetera, that are actually officers in terms of your bylaws, but they're actually not voting members of your organization. So the key thing here regarding voting members is to report in accordance with your bylaws. Quite a few nonprofit organizations at times will get this confused. And so they really need to report in accordance with their bylaws, and they also need to operate in accordance with their bylaws. I know a number of organizations that have, again, they have these ex officio members, they have immediate past presidents type of positions, and you've got to be cognizant of what your bylaws say regarding does that ex-past president vote or not. They still go to board meetings, but are they actually a voting member of the organization? Another thing is independent voting members of the governing body. If a member of your governing body is reported on Schedule J, or Schedule L, I'm sorry, which we just talked about regarding related parties, then they then become not independent. You're having those business transactions with a board member. They're providing professional services, a contract consulting agreement with a board member, and they report on Schedule L. They no longer are a independent member of your voting of your governing body, voting member. So keep those things in mind. Next slide. You report the powers of members of the organization accurately in Part 6 when it comes to the 990. And what we're talking about here is members. You've got, for organizations, you have potential individual members, but you also may have a situation where, again, according to your bylaws in your corporate organization, you may have a sole member of your organization, which is another nonprofit, for example. And it's very important that you report those powers in terms of answering the questions of lines 6 to 7B in the Part 6 part of the 990. So again, this is just kind of a helpful reminder regarding reporting your governance, and those questions ask things such as, do members have the ability to make significant decisions? Do they have voting membership, etc.? So getting your governance reported correctly on your 990 is a key thing, and it can be a little bit complicated. So keep that in mind. The last thing that I wanted to just note is that on Part 5, line 1A, you are required to report in Box 3 the number of 1099s that you report. And 1099s are the annual information filings that you do on a calendar year for the IRS. This is reporting those payments that are over $600 annually to independent contractors. And so I just wanted to just kind of keep in mind that the IRS does change those rules and regulations regarding 1099s on an annual basis. And I just want you to be aware that that's the case, and that you should always have a kind of a go-to place, whether it's CPE or maybe your payroll provider or your accountant can provide you with the updates regarding, hey, what has changed from the prior year regarding 1099 reporting. You want to stay on top of that, because the IRS is really out there looking closely at 1099 reporting of independent contractor revenues, and so you want to be on top of your reporting for 1099s. It's a one-time-a-year type of thing, and you need to stay on top of that. So those are the things regarding the 990 that I wanted to point out to in this webinar, and so I'm going to pass the baton over to Jim for uniform guidance.
Thank you very much, Gary, and also thank you to the, as I'm looking, 50-plus people who have made it through a FASB and IRS update and still want to be here for a compliance update. So I want to thank you as well, and also remind the 50 of you that are out there that we are accepting questions, so go ahead and send those to us via the built-in question feature in the software. So I get the pleasure of speaking for a few minutes here on the uniform guidance, which is the guidance that's applicable to federal award contracts. This is a training that could probably be done over a 2-day period, and again, I get about 15 minutes to do that. So I'll do my best to give you a little bit of background and some of the pertinent information. Why was the guidance issued initially? It was actually a law that was passed about 5-6 years ago that created an opportunity for better financial management of federal awards. The government came out with the goals of reducing the administrative burden for those who are receiving federal funds, while also reducing risk of waste, fraud, and abuse. They wanted to improve the integrity of financial management and operation of federal programs. They wanted to strengthen the accountability of federal dollars by improving different policies, and increase the impact of programs by minimizing the time that is spent complying with, this is great, wait for it, unnecessary burdensome requirements. So the goal of this guidance is to reduce the unnecessary burdensome requirements. Why is this document 119 pages? But that's another topic. So the uniform guidance took 8 previous circulars, if you remember the A133, the A110, and the A122, and essentially created one document. Us accountants absolutely love this because it's one place to go for all the information divided into convenient subparts. And there's 6 of the subparts plus some appendices to that. The first 5 subparts really contain the meat of the uniform guidance and how to apply it from a not-for-profit organization perspective. And the last subpart deals specifically with the audit requirements for those. I included a very, very brief timeline of some of the key dates here. You can see that the final uniform guidance is actually issued back in December 2013 and became law on December 26, 2014. But what I really wanted to point out here is the creation of what's called the Council on Financial Assistance Reform, or COFAR as it's referred to. The COFAR is an interagency group of executive branch officials who coordinate financial assistance. Their activities include providing recommendations to the OMB on policies and actions, to effectively deliver, oversee, and report on grants, as well as providing best practices and innovative ideas. And I'll talk about the COFAR in a little bit, but it's very important that you recognize this body because they are producing frequently asked questions, or FAQs, that actually become very important to understanding the uniform guidance itself. So the effective dates for the guidance, I mentioned it was actually issued back in 13, became law in December of 14. The first 5 subparts A through, I'm not very good with my letters here, A through E, became effective for any new grant awards after December 26, 2014. Subpart F, which has to deal with the audit requirements, became effective for any fiscal years beginning on or after December 26, 2014. So the audit requirements have just become effective for those entities on a calendar year end for December 31st, 2015, or very soon here in about 2 weeks, you'll be experiencing the effect of the audit requirements. Back to the administrative and cost principle changes, those awards, depending on the date of the award or any substantial funding increments to those existing awards, depends on the date of the award was made. So again, it's very important to understand when your grant agreement was received to determine if you're following the new guidance or the old guidance.
That's not going to get confusing at all.
Not at all. Not at all. So one of the topics within the guidance that has taken a lot of attention in the industry is the idea of internal control. And previously, internal control was only addressed in the federal circulars in the audit requirement. Why it was in the audit requirement, it makes a lot of sense for us auditors, but it didn't make a lot of sense for the nonprofit organizations who had to comply with that because it wasn't directly in those circulars that were applicable. So they took it out of the audit requirements and made it part of the overall guidance, included in Subpart D. And I've included the definition here on the screen for you. And I've highlighted a couple key aspects. The non-federal entity, or the not-for-profit organization, must establish and maintain effective internal control over the federal award that provides reasonable assurance that the non-federal entity, the nonprofit, is managing the award in compliance with statutes, regulations, and terms and conditions. So it's very important that there's controls in place to manage the awards. Now that word must equals required. And I mentioned the COFAR earlier. COFAR frequently asked questions number 3 defined must as a requirement. So when you see the word must throughout the uniform guidance, it means you have to require with that. So the requirement is that you must have a system of internal control. Now the guidance goes on to continue and say these internal controls should be in compliance with a guidance known as the Green Book, and also COSO, the Committee of Sponsoring Organizations of the Treadway Commissions. For those of you who are familiar with financial statement audits, you might already know and have understanding of the elements of COSO, such as control environment, risk assessment, control activities, information communication, and monitoring. Now it's a best practice that these same elements are applied to your federal awards. So obviously there's going to be some judgment involved in determining the level of internal control that's most appropriate and cost effective for every nonprofit organization. And one other comment with regards to internal control, I want to mention that reasonable measures must be taken to safeguard personally identifiable and sensitive information. So that's another key element of internal control. Now on to procurement, which again is another highly debated and talked about section of the uniform guidance. The good news, when the guidance was first issued, is that they included a 1-year exemption for the procurement requirements that are included. They understood that nonprofit organizations, it will take time to update policies, procedures, put in documentation requirements in order to meet the new standard. Even better news, again, it's my favorite body, the COFAR, frequently asked question number 3, extended this to 2 years. So an organization that has a June 30th year end can elect to defer the procurement requirements of the uniform guidance, now just the procurement requirements, not all of the uniform guidance, until the fiscal year ending June 30th, 2017. Essentially, they have to become compliant with the new procurement requirements on July 1st, 2017, if that election is made. That election has to be made in writing, and it has to be documented and maintained by the nonprofit organization, and you can still early implement the procurement requirements. And Gary, Janice, and I have worked with a number of nonprofit organizations to review their procurement policies to make sure that they're in compliance, and have been helping to early adopt these provisions. I think there's a lot of benefit to doing so and kind of working through some of the more difficult challenges, aspects of it now rather than waiting until 2017. So what has to be included within the procurement policy? Here's that must word again. And so it's required that organizations must have written procurement policies. Written procurement policies should reflect all federal laws, obviously the standards of the uniform guidance, and any applicable state regulations that would be impacting to your not-for-profit organization. Organizations must engage in full and open competition. So when you're doing your procurement, you cannot have unreasonable requirements of potential vendors that really limits the competition, unless it gets into a sole source situation, and we'll talk a little bit about that. You have to deal with things such as complexity with geographic locations and other items specific to your organization. Conflict of interest is a very important part and must be addressed as part of your procurement policy as well. Best practice is to document your conflict of interest annually, and done with any actual or potential vendors that you're working through with your procurement policy. And finally, maintaining records for all procurement activity. This will really be a new step for a lot of not-for-profit organizations, where in the past purchasing decisions were made kind of on the back of an envelope or through discussions. So now every purchasing activity needs to really be thought about. Are we following the steps that are in the guidance with respect to this federal award, and do we have documentation to support this conclusion? What I've been saying to a number of the organizations that I work with, when in doubt, write a memo about it. Document it and keep it. That way there's documentation that exists that says you've gone through a procurement policy discussion, you follow the policy that you've outlined, and there's documentation to support it. The guidance specifically identifies 5 levels of procurements that need to be addressed within your policy. Those are known as micro purchases, small purchases, sealed bids, competitive proposals, and sole source. The vast majority of the organizations that Gary, Janice, and I have worked with, their procurements will fall in the categories 1, 2, and potentially 5. Micro purchases, you can see the threshold currently is $3,000. For micro purchases, there's no competitive quotes required if management determines prices are reasonable. When practical, you want to distribute equitably among qualified suppliers. So it's very informal when it's underneath $3,000. When you get to $150,000, you become suspect to what's called the simplified acquisition threshold. The current threshold is $150,000, and here informal procedures are considered acceptable. However, price and rate quotes must be obtained from an adequate number of sources. So here, even though the procedures might be less formal than what a competitive proposal or a sealed bid process would be, you still have to do due diligence and go out there and get a number of price and rate quotes for those purchases that fall between $3,000 and $150,000.
So as I look at that, Jim, if I have a $5,000 small purchase, it's going to fall into that bucket, and I need to have potentially competitive multiple quotes for that?
That's correct. Excuse me. Again, informal procedures are considered reasonable, so you can have a discussion with those that are in management regarding who you're going to get the proposals from. You don't have to advertise it. You put it out there for open competition, but then you must obtain more than one price or rate quote.
And I think I heard you say, and you must document it.
You're going to hear me say document, document, document throughout this process. So when in doubt, write a memo about it, right?
Your auditors are going to ask for it.
Actually, I should trademark that. Anyway, so sealed bid and competitive proposals, that deals a lot when there's acquisition of large equipment or construction activity. And sole source deals specifically when there's a public emergency or it's such a unique purchase that there's only one type of vendor where you can obtain certain goods or services from. Again, if you're in a situation of a sole source procurement, you're going to want to, again, document that as well. I did attempt to include some graphical art in my presentation. However, that was denied by those who are in charge of this webinar. So I actually went out to Uniform Guidance itself and pulled their attempt at some good art. And they've included here, it's actually in the guidance. So you go out to the 119-page document, you'll find the procurement clause. And I just have it here as a quick reference to you. So as you're dealing with procurement and talking about procurement with respect to your organization and the uniform guidance, remember the clause, the procurement clause, and includes those 5 categories that I just briefly went through, as well as the general standards and requirements on the right paw, if you will. So I just want to share that with you. One of the cost principle changes that I want to talk about, and there are many, many, many cost principle changes throughout the uniform guidance, and that's included there in those subsection D, is cost allocation. And generally, there's no universal rule for classifying certain costs as either direct or indirect. No organization is exactly like another, and you're going to have a difference between the two. So the uniform guidance clarifies a number of cost allocation rules, and specifically more costs that are expected to be reimbursed as direct cost. For instance, if you have program administrative personnel who are directly working for a program, previously you might have categorized those as indirect, but if 100% of their time and activity and their administrative in nature is direct to a program that is funded through a federal contract, that can be considered a direct cost. Direct costs still have to be allowable, reasonable, allocable, and consistently applied, so you cannot flip-flop between a direct and indirect determination from one year to the next. One nice thing about the guidance is that it expressly requires all federal governments and awarding agencies to reimburse a nonprofit for reasonable indirect costs it incurs. And an indirect cost is a cost for a common or joint purpose benefiting more than one program, not readily assignable to one program itself. So you'll see here that there's this concept of a de minimis rate of 10% of the modified total direct costs. So nonprofit organizations who have never had a federally approved indirect cost rate can elect either the de minimis rate, which is 10% of their modified total direct, or negotiate a higher rate within the constraints of the federal cost principles. If you already have a cost rate, you're kind of out of luck. You have to follow it and go from there. There's been some confusion out in the community regarding this 10%. A lot of organizations feel it's entitled to get 10%, and just because there's a de minimis rate, you're required to get 10%. That is not the case. Just the fact that they have it does not mean you get it, and what you really need to consider is going back to the intent of the grant award. And if the grant award was never intended to fund indirect costs, good luck trying to get 10% from the government to cover your indirect costs. Again, go back to the actual grant agreement, and that'll really dictate what is and what isn't allowed. Very quickly here on the indirect costs, in order to get an indirect cost rate, you have to go through what's called an indirect cost rate proposal, or ICRP. Previously, we called it cost allocation plan. I'll probably continue to still call it the cost allocation plan. And this is something that's submitted annually to the cognizant agency for indirect costs. So that's a big, long title, essentially, for the largest provider of your federal awards. So if you get federal awards from multiple federal agencies, such as Department of Agriculture or the Department of Homeland Security, the one who provides the largest is your cognizant agency for indirect cost. Once they accept your cost rate, it has to be accepted by all the other entities, all the other agencies as well. That documentation should include things I've included here: org charts, your statements and supporting schedules, the actual calculation itself, and now it's required to be certified by the CFO or the equivalent. The final subsection that I want to talk about is that subpart F, which is the impact to audits. The audit threshold has been raised from $500,000 to $750,000, so a $250,000 increase, which doesn't sound like a whole lot in the grand scheme of the federal awards that are done on an annual basis. However, it's taking 5,000 not-for-profit organizations off the list of having to have an audit, which I think accomplishes one of those goals that I set out at the beginning of my presentation. It still makes 99.7% of all federal funds subject to audit, so it's still meeting the requirement of proper oversight. Now, I worked with some organizations who are in that in-between area between 500 and 750 who might not have to have a single audit going forward. And they've asked me, do I still have to follow the uniform guidance? Well, absolutely, yes, you still have to follow the uniform guidance. It just means you don't have to follow the subpart F and have an audit done. You're always required to make all records available to federal agencies for review, pass-through entities, and the Government Accountability Office as well. The threshold for audit coverage has changed slightly. So if your organization fell into the category of a low-risk auditee, previously we had to cover 25% of your federal awards. That has now dropped to 20%. And unfortunately, if you were not a low-risk auditee, that is now 40%, but it's better than what it was at 50%. The threshold has been raised as well. Previously, audit findings in excess of 10,000 had to be reported. Now this is 25,000. A few other impacts to the audit. We as auditors, we didn't like this very much, but now we have less judgment to determine whether a Type A program is low risk. A Type A program is one of your federal programs that's greater than $750,000. Previously, there was some subjective requirements in there that would help us determine whether or not it was low risk, and then ultimately excluded from testing. That has been taken away. And now we as auditors have to perform risk assessments on certain Type B programs, where in the past that wasn't the case. So what does this mean to you as an organization? Your auditors might be looking at new and different programs this year as compared to the prior years with respect to your single audit. And your single audit report will now be posted publicly on the Federal Audit Clearinghouse. I've included a slide here on resources, and I'm happy to share these links with anybody who wants to reach out with me directly and have a conversation on uniform guidance. But I get the question a lot, where do you actually find the guidance? So I've included those links in the presentation. The first PDF is the original document that was issued back in 2013 and became law a year later. But I really want to point out here the ECFR, which is the Electronic Code of Federal Regulations. This is the live breathing document on the government website that updates for any of these changes that the COFAR is issuing. So I would really concentrate on that second link on this resource page as you go forward to make sure that you are understanding all the requirements that are within the uniform guidance. Finally, a plug to the 2016 compliance supplement. This is very important for all organizations to read on an annual basis to make sure that they understand the changes within their awards. Just because you get an award from year to year to year, the compliance requirements might change slightly, and this document will be what you want to look at to make sure that you understand those changes, and your auditors will be doing that as well. So that is my update on uniform guidance, and I'm going to kick it back to Tyler here, and then we'll be back.
Great. Thank you, Tyler. There is one question that has come in, and it is about the grace period that you referred to, Jim, related to the uniform guidance. Can you just revisit that and clarify that? Because these dates can be a little tricky, and there's a lot of good news with increased thresholds and audit thresholds in the uniform guidance, but I'm not so sure the grace period's been clarified.
I'd be happy to do that, Jens. And for the record, I'm winning 1-0 in the question department. So if you want to make sure I win, continue to send those questions in. So the key date to remember with respect to the uniform guidance is December 26, 2014. Any award received after that date is subject to the uniform guidance. Any award received prior to that is subject to the old 8 circulars, the A110, A122, and A133, etc. So 12/26/2014. Now they did provide, the guidance does provide for a 2-year grace period, 2 full fiscal years following that date with respect to procurement. So for the procurement provision specifically, if you are a June 30th year end and you've elected to take this deferral, the last year that you are under the old circulars would be June 30th, 2017. You would essentially need to be live and following the new guidance on July 1st, 2017 going forward. I hope that clarifies a little bit.
Great. Thank you, Jim. Okay. I think that's all the time we have for today's webinar. We certainly appreciate you joining us today. We hope you can join us for future webinars, and have a great afternoon.
Thank you once again for joining us for this presentation produced by McConley and Asbury. We hope you join us for our upcoming events. You can stay up to date with news and learn more about our upcoming events by visiting us at www.macpas.com. Thanks again, and have a great day.